Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we're back. Episode 135 of Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, this one is holy smokes. Are the lows in?
So we talked about what color is the smoke now? Is it white or black?
I don't know. The Bears are putting up the white flag, potentially. We'll talk about it. But you live in the great city of Chicago. Is your chest out a little bit with the first American Pope, who's a big Chicago White Sox fan? I think that's awesome.
I know. I almost put my Cubs hats just because like the biggest Chicago thing. Then I was like, that doesn't quite fit. He's a Sox fan. So. But still, like, maybe they'll start serving deep dish pizza in Vatican City.
Well, hey.
Or like Vienna beef, a little bit of that, and some Malort. And
if your boss likes deep dish pizza, you might have to eat it.
I think you get a little Lou Malnati's there. I'm not a big fan of Giordano's. Anyone listening, if you know Chicago deep dish, it's not even like I'm a big fan of deep dish. I like it. We'll do it once in 3 months or something like that. We get a little bit of a craving and. Like, oh, let's do deep dish. And then you remember, like, I think I like the thin crust stuff better. But, it is heavy, but it's fun to do. And my favorite over here is Lou Malnati's. We don't know what the Pope's favorite is, but Ryan, maybe that's a cute...
Illuminati? What's it called?
Lou Malnati's.
Oh, like Illuminati, like,
Yeah.
Anyway, with Pope's Illuminati. Anyway, okay, like, what's that?
Yes.
Well, Dan Brown, like a Dan Brown book. Anyway, Dan Brown novel, I should say. All right, well, anyway, so that's pretty cool. Congrats to Chicago, and that's neat.
Pretty cool. We'll see when he comes. I'm curious when he'll make his next trip here. He's been in Rome / Vatican City for a long time.
Sure.
I think he was sort of like he came out of the blue in terms of the folks being nominated as Pope, but it happened pretty fast. It was pretty cool.
Yeah, I don't know if I mentioned this last week, but if I did, I'll do it again. Apparently, Vatican City has 18 Bloombergs. Only like 880 people live in Vatican City. They have 18. There's more Bloombergs per capita in Vatican City than anywhere else in the United States. So I don't know where you go with that, but just think of that one. But Sonu, let's go with let's start with trade, right? I mean, we come in, we've had a big rally. You and I have talked a lot about some of the positive things taking place. There are risks, there are concerns, absolutely. And then we come in Monday morning, and the Dow was up 1,000 points as the open. Now, I get it. This is points versus percentages. We fully get it. But just still remember this. Only 2 other times in history has the Dow gapped up at least 1,000 points. That was back in COVID times, 2020. So on a percentage basis, sure, it was more. But what shocked me, honest to goodness, and I want your take on, the trade stuff, but just how the market reacted. We had this big gap up. Honest to goodness, I thought we'd see a little bit of a sell-off. I thought we'd see some weakness in the afternoon. We started to see it around lunchtime. Then I got busy doing some things. I looked up, like, we finished, like, darn near the highs of the day.
Especially the S&P 500.
S&P 500, the NASDAQ's officially 20% from the low, so in a new bull market's what they tell us. I don't know. That was really impressive to me, the message of the market. I'm an old school technician, CMT, John Murphy. What's the market telling us? We can talk about everything we want to talk about. To me, the market is saying it doesn't want to give people much time to get in. And when you look at this rally, that's what we've had. But let's talk about trade. How did you expect to see 10% U.S. Tariffs, 10% reciprocal in China, with the 20% still saying on fentanyl? Because on Friday, President Trump floated out 80%. He floated that number out, and then we come in, and that's why we rallied. Talk about trade, Sonu. What are you seeing?
I think, did I expect it? I'm going to say no. Am I surprised? Sure. I'm also going to say no, because we were looking at like real-time data, shipping data, all of that. Things were collapsing, right?
Yep.
We had pretty much a trade embargo from China. Christmas was in danger of being canceled. Thanksgiving, everything, Halloween to Christmas. You and I talked about that.
That is not a good way to win midterm elections.
So which is why I'm saying I'm not surprised. And they pulled all the way back. So let's get into it, right? So they had weekend talks in Geneva. Treasury Secretary Scott Bessent met with this, and trade rep Jameson Greer They both met with, the Chinese counterparts. I'm not even going to try to pronounce the names because I tried yesterday and didn't get it right. But so what happened? U.S. and China jointly agreed to a massive cut in tariffs. At least for by the way, this is a 90-day pause, right? But I think at this point, the market's like, yeah, right. We've heard this 90-day pause thing before. This is done, right? You tried staring us in the face, we stared you back, and you blinked, right? I mean, that's basically what the markets told the Trump administration. But let's go through what happened. The reciprocal tariff rate of China falls from 125% to 10%. The 20% fentanyl tariffs, which were imposed back in March, that stays in place. So the China tariffs, the new ones, in addition to what we had from the first trade war and through the Biden administration, the new ones this year is now 30%. Right? For everybody else, it's 10%. China, in return, is going to cut its 125% tariff rate on U.S. goods to 10%. And this is the thing, right? Like, it's funny. The U.S. said, "Oh, we have a deal," and this is not like this. This is a pause. This is a reset. We'll talk about how I'm thinking about markets too. I think it's a reset back to pre-Liberation Day. That's what it is, right? And the thing, what China always wanted, and by the way, China doesn't refer to this as a deal. What they call it is an economic and trade consultation mechanism. How is that for a really boring title, right?
Wow.
Essentially what they said, we've agreed to talk about trade and trade barriers. Pausing the tariffs, I think, was always a precondition for China to engage in talks, and they got that. We have the pause. Talks are going to start. What did China need before this? They said, we want the tariffs paused. I got pulled that down to 30%, probably better than what China expected, by the way. And they also wanted 1 point person for the talks, and they didn't want someone like Peter Navarro. They got Bessent instead. A lot better. They wanted the talks to take place in private, and they got that by the choice of Geneva. And they also wanted more conciliatory, respectful negotiations. Here was one thing I thought was really positive. President Trump didn't front run the news. Every other time he's like the first one to post on Truth Social. Like, this is happening. Buy stocks, do this, do that. Like, he's always front running this stuff. There was not a word from him. It was Scott Bessent. I think you were on CNBC yesterday morning or something. Bessent was on just before you, or so that's when they broke the news. So I thought that was very positive here. What did the U.S. get? They got a rollback of non-tariff measures that were imposed by China since Liberation Day. In addition to getting the 125 down to 10, these are like China pulled back export controls on rare earths, and China said we'll buy more Boeing planes. So good for Boeing.
So I'll jump in here. Great summary, and obviously, again, the bottom line is that's the 10% was a lot less than most people expected, much like Liberation Day. I mean, you listen to this podcast, and thank you. We've had a lot of people listen to our podcast. No, we did not see a 10% drop the 2 days after Liberation Day. You say we were wrong if you want. A lot of people didn't expect that. That was way extreme. Just like now, though, it's more extreme the other way. A week ago, I didn't really personally think we'd have a deal with China in play, or at least a potential deal with China in play by Monday, or a pause at 10%. I mean, that's, and they agreed to it. Now, I will say this. I heard some rumors on Saturday that they're in Switzerland working. Apparently, they skipped lunch. They were working through lunch. And I was like, people took it bullish. I said, no. If that's me, I start getting hangry. Maybe you're not going to get a good deal. Hopefully, they just use DoorDash. I don't know if you can use DoorDash over there. But nonetheless, that showed that. Now, I will say one quote that caught my attention. Jameson Greer, like you said, big part of the trade deals, trade negotiations. His quote, if I can read my writing, the differences were not as large as may be thought. That got the quotes. That was out there. I mean, I was like,
after all of this time, it's like, wait a minute, you're talking about like you went to 145% tariffs, and now you say the differences are not that great, which is perfect, by the way. I love hearing that. As far as markets are concerned, that's what I want to hear. Differences are not great. Okay, perfect. Let's take that.
So maybe the difference were like we don't want to crush the global economy on both sides. I will say President Trump on Friday, in one of his tweets, he's like, it's a good time to buy or something like that. Now, maybe he knew this deal was coming, but like you say, he didn't front run it, so to speak. So I want to talk about market reaction and the strength, but anything else, Sonu? You get a trade deal, you get a trade deal, you get a trade deal. UK obviously got their deal last week. There was some exemptions on steel and aluminum. They're like I don't know if you can say it like this, but I just will. Probably our best partner we've had in a long time. So of course they're the first one to get a deal. They don't buy a lot of our stuff. Yeah, somebody
has been asking us for a deal for 10 years since Brexit, and we're like, no. And finally, like, we'll let you export 100,000 cars to the U.S.
So that wasn't a shock. They were deal number one.
Yeah.
But nonetheless, what about, India's out there, Japan, other parts of Europe? I mean, again, you read the same things everyone else, but are more deals coming sooner than later, you think? Or what's your magic 8-ball tell you?
I'll put it this way. We're not going to get deals for proper trade deals for a long time, including with the UK. These things take a long time.
Okay.
But we got to pause. We're not going to get, I think there was, as someone said, the administration's not insane. Mm-hmm. And last month after Liberation Day, there was a question about
there was a question. There was a question. Yeah.
So, but not anymore.
Yeah.
Right. And the question, we landed at 10% tariffs, and irrespective, did we have to go to 145 to get to 10, or did we have to go to could we just have gone from 0 to 10 and things would have been fine? But anyway, this is where we were, right? I think long and short of it is the UK one is really small. They have to, they said tariffs of 10% on the first 100,000 vehicles imported from the UK. And by the way, that was because of President Trump, because he likes Rolls Royces and Bentleys and Range Rovers. He's like, we need to let those in. You're not bringing a Hyundai and Kia in. That's going to be tariffed at 25%. But you guys can bring the Rolls Royces because those are cool cars for 10%. Fair enough. U.S. tariffs on UK steel, aluminum, that's going to go to 0 instead of 25%. Meanwhile, 3 cheers for the UK beer industry, because UK tariffs on US ethanol is going to go to 0, right? So that will be good for the UK there. But after all this, look, we still have tariffs, by the way. The tariff rate, the average tariff rate before all of this stuff at the start of the year was 2.4%. That's going to go up to 17.8% after all this, with the 30% tariffs in China, 10% on everybody else. And that's assuming people don't shift. Let's say suddenly I have to pay 30% tariffs on my Barbie doll that I'm going to buy for my daughter. So instead of that, I buy, another doll from Mexico or something like that, right? That's not manufactured in China. So what we call substitution effects. If you account for substitution effects, and this is via the budget lab at Yale, the tariffs, instead of 17.8, the average effective tariff rate will be 16.4%. By the way, that is still the highest since 1937, right? So that's where we are at, big picture, tariffs. But at least we can breathe. This is like a bad dream. That's over.
Well, is that what I would call that a nightmare? I don't know if that's all right. So again, we are aware fluid is a situation from what we were worried about and fearful of this time 5 weeks ago. It looks like calmer heads have prevailed, and we'll talk more about the economy things. I want to talk more about the reaction to the stock market, though, here for a second.
Let's do that.
The S&P was up over 3% on Monday. From the intraday lows on April 8th, the S&P is up more than 20%. Who knows? We're recording this Tuesday morning. We might be up officially 20% from the April 8th closing lows. But our good friend Jeff DeGraff over at RenMac, we talk about Neil a lot, their economist. Jeff's their technician. I've learned so much from him. He's awesome. He's got the DeGraff breadth thrust, in essence. Okay. He's got his own coin, and keep it simple. And Josh, I just sent you 3 charts. The first one,
I want a Ryan Detrick breadth thrust. You should come up with one.
It's funny. I just did it. So hold the Jeff thoughts in a second. Okay. I'll get there. I just did right before we did this one, like a 25-30 minute interview with my friends from pre-market prep. Shout out to those guys. And they said, you need to have a breadth thrust. I was listening. I said, I do.
There you go.
I don't know. I said, maybe I'll take the one when the S&P is up 3%. I'm sorry, up 1.5% 3 days in a row. That's we mentioned it last week, but you're higher a year later, 10 out of 10 times. So lows are normally in. Maybe that could be the Detrick breadth thrust.
And let me take that as homework. Yeah. I'll come up with something.
Yeah, we share a lot of these. But on the screen right now, on YouTube, we're going to share this. And this is, again, courtesy of Jeff DeGraff. He discovered this many years ago. When more than 55% of all the components in the S&P 500 hit a new monthly high, so a 20-day high, like we just saw Monday, it was 58% actually on Monday. That is usually a very bullish signal, okay? 1, 3, 6 months later, you're talking strong performance. Here's where I thought it was interesting. A year later, S&P is up 29 out of 30 times, and the average return is it's almost 18. If I read my writing there, I read that about 18% on average. I mean, so again, this is a different buying thrust that we haven't talked about before. I've listed a lot of these the last several weeks, but to see that is really, really a big time positive potential. And Jeff DeGraff, the DeGraff thrust, I guess is what it's
the DeGraff thrust,
affectionately known. Oh, there it is. Sorry, 16.3% average return a year later, but again, higher 29 out of 30 times. Let me do one more. Josh, the second one I sent was when you're up big the previous month. So as everyone knows who listens to this podcast, it was a bloodbath until April 8th. The S&P was down 10% the 2 days before. The S&P was down like 12% the previous month. We talked a lot about, listen, just be aware the worst days tend to happen near the best days. And what normally happens, you get your worst days, people panic, people get out, and then you get the beach ball under the water effect, which is exactly where we are now. S&P, as of just a couple days ago, is up 13% in 1 month off the April 8th low. I took a look, Sonu, when you're up 13% in 1 month. Last time we saw something like that was the lows of COVID, coming off the lows of COVID.
Okay.
Early 2019 and the summer of 2009. I mean, just think of those times. Those were not the worst times to be bearish. Those strong buying thrusts and strong strength over a month usually meant the lows were in. Sure enough.
They call it the Ryan Detrick beach ball indicator?
Yeah, the beach ball indicator. Exactly.
The Detrick beach ball indicator.
The Detrick beach ball indicator. I like it. No, my blog, carsongroup.com/research is I titled it something along the lines of why this market's like a beach ball. I like that. But similar to what we've been laying out there, strong forward returns, like we're showing on the YouTube channel right now, are perfectly normal, perfectly consistent, Sonu, with what we potentially could see in the future. And we get it. This is just past data. Past data does not necessarily predict the future. I would use future data if I had it. I don't have that. If only. Now, the last one, Josh, this is the third chart that I shared on the YouTube channel. I might have mentioned it last week. I don't remember. You don't remember. We're going to talk about it one more time. We had an 18.9% near bear market as of obviously April 18th. We recovered more than half of that now, officially, especially after Monday's rally, even as of last week. When you recover more than half of a previous bear market or near bear market, Sonu, 16 times I found it, only once did the market roll over to make new lows, okay? And it was actually the last time in 22. We recovered the big rally in the summertime and rolled over in 22 to make new lows in October 22. But that's the only time. If you look at all 16 times, when you recover half of that previous near bear market or bear market, S&P's higher, drum roll please, 16 out of 16 times a year later, up about 18% on average. So these are just different ways to look at it. But to me, when you stack all these on top of each other, like a lot we've been sharing on this very podcast going forward, we are aware of the risks. We are aware of the worries. You know, the market's telling us, I think the lows are in, and I've honestly been saying that for a couple of weeks after listening to this podcast. And it doesn't mean it's going to be straight up. I mean, it's going to be easy. It's going to be more volatility, sure. But, you know, last thing, the time we're doing this, S&P's flat on the year. S&P's less than 5% away from an all-time high. We were down 15% for the year as of early April, right? Only 3 times in history has the stock market been down 15% for the year, some point during the year, and made it back to positive. It was 82, 2009, and 2020. Some big reversal years that actually kicked off some bullish phases. So, hey, you know, I think there is some more upside to this. We're working on mid-year outlook. How much is there? We'll determine that later. But there's probably a decent amount of upside still, even though we're flat. You know, what a boring year. Even though we're flat on the year. So, no, I just said a whole bunch. You want to talk about markets more, or we're going to go to the Fed next? What do you want to do?
Well, let's talk about. Let's stay on the topic of markets. I am looking at. Two things. So this is via a friend, Sam Rowe. Okay. Goldman Sachs says, oh my God, where can I find it? So Goldman Sachs increased their target for the S&P 500 back to about 6,000 or something. Goodness. Ed Yardeni was bullish and then bearish, and now he's bullish again. I think it's back to 6,500 or something. And just for context, everyone, the S&P right now is at about 5880 when we are recording this on Tuesday morning. Okay. May 13th, right? So just to give you a sense of Goldman's back above 6,000, Ed Yardeni's back 6,500. And, you know, wait till our mid-year outlook to see where we are. We won't give out, you know, give too much of it away. But still, what do you make of that? Everyone's now bullish again.
I mean, I guess that's simply how it works. I mean, I hate to say it like that. I mean, we see this, everybody gets all bared up, they panic, they sell. Who was it? It was Goldman on Monday said now they see a 35% chance the U.S. goes into recession.
I want to talk about that.
Okay, it was 45. Okay, so jumping ahead of you.
But
so we'll get to that in a second.
Yes.
We'll get to that in a second. But I mean, that's kind of how this stuff works. We truly were. I mean, every year is uncertain. Every year is scary volatility. Every year is bad headlines. We've talked about that literally every week for 135 episodes now. So you shouldn't be shocked that this year had some scary headlines and some volatility. Yeah, I mean, it was more volatility than normal. The VIX is back sub 20 though, so we're kind of back in this normal world. I get it. I mean, we manage money. I think, we came into this year overweight equities, right? And we've talked before in our unconstrained tactical models, we're talking 91, 92% in equities the last couple of years. We have dialed that back on, I believe it was March 3rd. March 3rd, we made some fairly significant kind of changes out of equities, kind of honest to goodness, book some profits, if you will, because we've been bullish and we did well, but we're still overweight equities, but we have more exposure, international than we had the last couple of years. For the last couple of years, we said, hey, U.S. looks darn good. You want to be in the U.S.
Pedal to the metal, bullish equities and pedal to the metal overweight U.S. stocks, and that's not where we've been this year. I mean, this is all before Liberation Day, I should say.
Yeah, it's not like we just changed our tune. I mean, people think, oh, you're always bullish. It's like, yeah, if you have a diversified portfolio this year, have you seen what Europe's doing? Have you seen what emerging markets doing? Have you seen what frontier markets are doing? I mean, there are some companies. I mean, literally Israel's been hitting all-time highs. I mean, Israel, the stuff going on in Israel's stock market's hitting all-time highs. I mean, that tells you, and I've been saying this for a while, I think the U.S. plays catch-up. I think the U.S. will get to new highs pretty soon, and it's less than 5% away, so it's not like some wild call to say that. But most countries are hitting all-time highs or 52-week highs. The U.S. probably plays catch-up. But to answer your question, it just makes me smile that you get these targets and it's one thing one day, one the other, and we have a target, and I hate having targets, but we manage real money. Okay, we've been overweight this whole year. No, it wasn't really fun to be overweight equities this time a month ago, but now here we are on the other side, and this is the what do we say? Volatility is a toll you have to pay to invest. Well, we had the volatility, and you better stick with some of the rough times to succeed when you have the inevitable bounce back. And fortunately, our models that we run for our Carson partners and their clients are having a pretty after two really spectacular years, we're doing pretty good. I mean, I won't say which model is. One of our models that was came into the year like 90% equities is up like 3.5-4% this year, which is, I think, incredible. I mean, we've done pretty good. Yeah.
And this gets to, we can talk about the Goldman thing now and recession probabilities, right? Or even like to your point about because we manage real money. It can't just be, today our target is 5,500. No offense to anyone. Like, it's very hard putting this stuff out there. And I know why they do it. We've done it too in our outlook. But you can't just have one day like, today's 5,500, something changed, so it's going to be 6,500. No, we just cannot have that level of turnover in our portfolios. Like, we'd be fired just for creating tax issues, right? So we cannot do that. Same thing with recession probabilities, right? When the Liberation Day tariffs were announced, Goldman put out, and I love the Goldman econ team. I think they're the best in the business.
Yeah, you've said that for years. I mean, Goldman is your top one. Yeah.
They got 2008 right. They got the 2022 the COVID thing, all of that right. I think they have a good framework for figuring out recessions and then associated bear markets, but mostly the recessions really. But after the Liberation Day tariffs were set, they came out and said, okay, 65-70% chance of a recession this year. And then we got the pause, and they immediately within 2 hours they redacted that. Because I get the PDF, right? I get the notes from Goldman. They redacted that. Look, this is a tough business. They're like, okay, now we're going back to like 45% chance of recession. And what does 45% actually mean? That's like a coin toss. It basically, we don't know. And then after yesterday, they dropped it to 35%, and I'm like, what is that? What does that mean? Like, what do I do with that information? I cannot do anything with the information that, today it's 45% probability of recession. It could be 35%. There's practically no difference, right? And I think that I wrote a blog about this last week. We haven't said we've been in a recession throughout all this.
Right. No, we haven't. Yeah.
We just didn't. And it wasn't because which is not to say we may not have a recession, or we may have a recession. Just that we don't know yet. right? Just follow the data. And so far, we have our own proprietary leading economic index for the U.S. and 29 other countries. And we just haven't seen the cracks falling yet. Like, the economy hasn't fallen off a cliff. You shouldn't have expected the economy to fall off a cliff, even after Liberation Day and all of that. And we didn't see that happen. Yes, some data was getting bad. There was like a trade embargo between the U.S. and China and all that. But I'll put up the chart for our proprietary leading economic index for the U.S. And it's still growing along trend.
Yeah,
right?
So Josh, we'll get you that chart. We can put that on the YouTube channel right now. You mentioned a word that struck me. You said get fired if we traded too much. And I love listening to podcasts. I used to read a lot of books. Honestly, I don't read books anymore. I listen to podcasts. There's so much information that I absorb. I love it. I was listening to one with Jim Simons, one of the probably the greatest trader ever. I don't know. I mean, he was incredible. I listened to a podcast with him, not with him. It was a podcast about his life on the Founders podcast. Love that podcast. Anyway, the quote from Jim: "Getting fired can be a good thing. You just don't want to make a habit of it." I love that quote. I wrote it down. But he was talking like again, literally, I think he was worth $22 billion at one point. I mean, you're talking about, just one of the wealthiest people to ever walk the face of the earth.
Founded one of the best firms.
They made like 30. They made like, I hope I'm close enough for government work, like 30% a year over like 30 years. Okay, you extrapolate that. You're talking, but anyway, he was fired. He was fired from his job. When he was young, he was doing some things. He was pushing the envelope, and they canned him. Right? He did stuff that I guess it was frowned upon back in the day. Then he went and started his own company. He's like, if I don't get fired, who knows? Who knows what happens? Anyway, amazing podcast. Check out that one if you're interested in it.
This is not a hint to our higher ups to fire us.
Well, I didn't want to go that route, but I've been fired before. I've been laid off before. I've had it all in my career, so it happens. We've all been there, and it's just kind of
fingers crossed. Not
anytime soon. But all right, so let's see. You want to talk about the Fed? You want to go to the Fed? You want to do that?
Yes, let's do the Fed, and we can talk about inflation data too. Okay. Actually, I'll talk about within the context of the inflation data, the CPI data that we got today. Real quick, CPI was softer than expected. Okay. And again, this gets back to the fact that you and I, for 2 years, when we started doing this podcast in 2022, September, what were we talking about? We talking about inflation. And we were talking about how all the data, by early 2023, I think you and I were talking about how inflation was last year's problem.
Yeah. Not many were saying that. Yeah.
And that's partly why we were bullish, too. Right? We thought, okay, an end to the rate hikes were coming.
Oh, absolutely.
And then in 2024 is about, okay, when will they start cutting? And that was because we were positive on the inflation outlook, right? But remember, almost every other episode, we were talking about all the lags in official inflation data, right? Rental lags, used car prices, new car prices, all of it. And now people are like, oh, see, we got April inflation data. There's no impact of tariffs. Like, wait a minute. By the time the government data captures this, even if it's there, it's going to be 2-3 months from now. And I'm going to see anything. So inflation data was soft in April, but that gets to the Fed. Sorry, I got a cough. I'm choking up here.
My joke is, sorry, I always get choked up talking about the Fed. I actually do that on purpose sometimes.
There you go. Yeah. So we got a soft data. What if we didn't have any of what happened over the last month? I think by now we'd be talking about potentially a second rate cut in June.
Okay.
So you talk about what have we actually lost? What have we missed? I think we've missed the upside from rate cuts because of all this, right? Because right now we just, like April inflation data came in softer than expected. Egg prices went down. Ice cream prices went down too. So go get your ice creams now.
There we go.
Airfares came down. That's good for travel. The only thing that's kind of worrying, but at the same time not, is food away from home. You and I have talked about that. I like to look at that food, restaurant prices, right?
You like to look at it. I like to eat it.
Yeah, that too. And restaurant and bar spending, that's up over 4% year over year. That's a little too hot for comfort, but it also tells you people are spending, right? Goes back to the fact that the economy is not falling off a cliff. Right. Yes, we may be getting less goods from China, or we did over the last month, but people are still spending. Right. And that's what the inflation data tells me. But all of this gets back to the Fed. The Fed should have been cutting now, and now they're going to pause. Right. Powell basically said, the risks of higher unemployment and higher inflation have risen. But then when they asked him, like, OK, what are you going to prioritize? Maximum employment or low and stable inflation,
Right.
he punted on the answer. I think they will prioritize inflation. Look, rates are already restrictive. And he said, we're comfortable with that right now. So what we've lost, going back to that, is we've lost some rate cuts. And I don't think we're getting a rate cut in June. I don't think you're getting one in July.
Nope.
It may be September.
Okay. Now, I can tell you're struggling there. Get some water. I'll talk for a minute.
Yes.
Here we go. So Neil Dutta. We can't go a podcast. I'll talk about our buddy Neil. Neil said it looks like the Fed is more worried about unemployment than in or they should be. Neil is more worried about unemployment than inflation, but he said it looks like the Fed is focused on the exact opposite thing. Said it's a potential mistake. Also, I'm just reading my notes from the Fed meeting. Powell said, quote unquote, we were a little too late to ease last year, is what he said. He almost hinted at what you just said, like maybe they should have done more easing earlier in the year. You and I talked about that. They did 50 basis points on September 19th. The only reason I remember that, it's my son's birthday. That's when and people said, oh, when you do 50 basis point cut, it's always a recession, because in the past it had. But we said, no, that's just a big eraser, because they should have done 25 the 6 weeks before. I had one other thing.
By the way, I'm with Neil. Yeah. I think they should have cut in January and March.
Oh, yeah. You and I were saying that. You were saying that.
I think they should have cut them. And now they've boxed themselves into a corner.
Exactly. And they knew the election. It probably had some politics. They knew potential policy. And one other thing.
Go ahead. I was going to ask you a question about, do you think there's some politics with Powell versus Trump?
Yes. Yes. I mean, well, I don't know, politics is the right word, but they knew who won the election, right? Yeah. And they knew what he ran on. I mean, tariff, the most beautiful word in the English dictionary. Yeah. That's what President Trump has said before, okay? That's not something we're just paraphrasing. He said that. So Powell knew that, and with the uncertainty over higher prices, that put him in a box. I think clearly that's why they didn't cut earlier this year. Also, he said, being Powell, it's not really all that clear what we should do, quote unquote. I mean, I know Neil kind of had issues with that, and you probably did too. But anyway, the reality is, well, that's why I want to take this, because then yesterday, the odds of rate cuts once again were lower. The odds of 3 cuts, you've got it. I know it dropped significantly, yet the market soared. I mean, honestly, I thought the market wanted rate cuts. Now it's like, well, maybe we're going to avoid a recession because these tariffs are out of the way, so maybe we don't need rate cuts, but the market actually is rallying. Trust me, my head exploded a little bit with what I just said. What's your take on that?
My take is we are seeing that in cross-asset pricing. When the day started yesterday, small caps are outperforming large caps by about 150 basis points. The S&P 500 is up about 3%. Small caps are up about 4.5%, inching towards 5%. By the end of the day, they almost finished. The S&P 500 finished higher, close to the highs of the day, about 3.3% up. This is Monday of May 12th. The Russell 2000 actually finished more or less at the same place. It pulled back about 1.2, 1.3% from the highs, from the morning highs, right? Same thing this morning. You know, the Russell 2000 started big out of the gate. And again, now the S&P 500 is outperforming. I think that has to do with we're now getting rate cuts as soon as we expected. And I think, look, if the economy hangs in there, God, I wouldn't be surprised if we don't get any rate cuts this year.
Right. Which would be interesting, because maybe the market actually likes that. Maybe the market likes no rate cuts because it means the economy is strong. Believe me, these are some confusing not confusing, but questions with no true answers. We're going to talk about it every week. But that's
if you get rate cuts now, like if there are emergency, you don't want want emergency rate cuts ever. That means the economy is in bad shape.
Well, like I said, when the Fed in the past had cut 50 basis points, usually because they were way too late, and it's like, there's the panic was in the air, and they're cutting 50, and that's because trouble was coming. Anyway, I'm going to change gears for a second. Happy Mother's Day to all the mothers out there listening.
Yes, happy Mother's Day.
What did you guys do up in Chicago on Mother's Day, Sonu?
We have 2 mothers at home because my sister's here too.
Right, so, and the baby, he was on the podcast last week. I laughed. You should just bring him on the honest to goodness. You should just bring him on the podcast. Bring him on the podcast. Literally hold him on the podcast. Whatever,
I know.
Whatever. Actually, our next one. Our next one. No, okay.
They'll be in Omaha. Maybe 2 weeks. She'll be here.
Yeah, he could do Friday, because we're recording on Friday with a very special guest. Want to say who's joining us? Want to say who's joining us? Might as well give it away to all our friends.
It's perfect timing with everything they talk about: inflation, Fed, the economy, tariffs. Yes, Skanda Amarnath from Employ America. Again, like a shop that's really gotten it right, because they delve into the macro data. They don't do what I like to call indicator macro. Here's this indicator; it's gone down. Here's the Baltic Dry Index, so everything's going to collapse. Here's M2, and everything's going to go.
ISM.
Right. But they dig into the meat of the data. I have learned so much from those guys. I'm really pumped to get Skandar and Skandar Amranath. He leads Employ America.
Yeah, he'll be next week. But back to Mother's Day. What'd you guys do then?
Yeah, so we went out for brunch. So that was nice. And I cooked a meal for, the mothers and the kids at night. So I spent, a couple of hours in the kitchen there. So that was good. Yeah.
Okay. Well, good. Yeah, we had, I guess.
What about you?
Yeah, we had, I think it was 3 basketball games and a flag football game. My wife said a few times, like, what is going on here? Why did they do all this on Mother's Day? But my boys did go 4-0 in those games. So there's that. We actually went to Texas to Brazil, one of those the Brazilian steakhouses. My kids that have been to it, red, you put the little card. If it's green, all the gauchos, I think they're called, run around and bring all the food to you, and you put it on red, they stop. So that was
Did he get enough meat?
Oh, I did my job. I tried to, because here's the thing I don't get. I don't know if they got me or not. Like, my daughter didn't eat any of the meat. My wife didn't, and I took my mother-in-law. They didn't. So all 3 of them didn't.
So this is just for you.
Yeah, that's what my wife said. That's what she said. I said, no, it's for the family.
Well done. Well done.
You read through that, Sonu. You read through that. But nonetheless, I mean, they have a great salad bar and stuff, and I just they like that stuff.
Oh, yeah, right.
Anyway, yeah. Anyway, but
Mother's Day, honey, I'm taking you to a great salad bar.
Sonu, be quiet. I thought we were friends. That's what you're supposed to back me up on this. But my boys and I enjoyed Mother's Day. Nonetheless, they charged the same price. It was like $65 a person, but like they charged the same price if you ate a bunch of meat or you didn't.
Really?
I'm not so sure about it. I said, I didn't want to make a
That's
big.
Not fair.
I don't know. I was like, really? They ate lettuce. Like, I'm eating filet wrapped in bacon, and they're eating lettuce, and they're charging the same. So I didn't want to get into it, but that didn't seem right. But whatever. It was nice, but someone who had, I guess this is the 3rd Mother's Day now without my mom, who passed away a few years ago. You just never know. So definitely you have a mama, give her a call, give her a text, and enjoy. I think it would have been the last Mother's Day. Yes, I lived in Charlotte at the time, and I actually flew up for Mother's Day because it was pretty clear my mom was sick where it was going to go. Yeah. And we actually, like our family always did, we ended up at a casino, and we had a lot of fun and probably drank one too many and had fun with my mom. And that's really cool. So I guess it would have been
that's a nice memory.
22. Yeah, 20, because I lived in Charlotte at the time. We flew up, and you see the little memories on Facebook or the memories on Google Pictures or whatever. It's like I was torn. Like, should I go up there? I travel all the time for work. I was like, I better go see mom because this isn't looking good. And I did, and thank goodness I did it. So my advice to anyone out there in a remotely similar situation is do that thing with somebody because you never know what the future might hold. All right, so get off my pedestal there. What else do we want to talk about? What else? I mean, how are we doing time wise? Yeah, I've got a meeting in 10 minutes, so we probably do need to wrap this up.
No, we talked about the Fed, and the why I asked you about the Fed and politics is, I wonder if there's some small part of Powell. Look, there's somebody in the White House basically calling him an idiot for not lowering interest rates. I wouldn't go that far. I think they should have lowered interest rates long time back. But President Trump is a lot more explicit than I am.
Yes, he is.
But I wonder if there's some small part of Powell that feels like, if I if I cut rates, I'm basically saying I was an idiot not to cut rates earlier. So I wonder if there's a little part of him that's like, you know what? Up until now, my legacy was going to be the Fed chair that beat inflation and landed the plane, a soft landing. Now I wonder if it's like, the Fed chair who stood up to Trump.
Well,
forget all else. I don't know. I feel like there's a little bit of politics there.
I think so. You're talking pretty alpha male personalities is kind of why they're where they are in a lot of cases. So yeah, I think there's definitely probably some of that. But again, I mean, now with if the economy comes back, maybe it gives them cover that he didn't need to cut. But we've talked before with the ECI, the Employment Cost Index, I believe at 2.3 or 2.2% year over year. You don't need short-term interest rates of 4.5%. That's restrictive. I mean, that's the thing you've been talking about a lot, and I can't disagree. But
and kudos to again Neil, right? He's been saying just because they paused, that doesn't mean it's status quo. It's not a benign status quo. Policy is actually getting tighter because of exactly what you said. Wage growth is easing. Right? That means the delta, the difference between wage growth and where Fed funds are, it's too high.
Yeah.
Right? And it's getting higher day by day, month by month, right? So the longer, let's say now the Fed's paused till September.
Yep.
Wage growth, we've got now about 5 months left through September, right? And it's like, wait a minute, like wage growth is going to continue easing. So we're going to have tighter and tighter monetary policy for the next 4 months. I think that is actually the bigger risk. Than anything to do with tariffs. I mean, I think this whole tariff situation is what landed us with the pause on Fed rate cuts, but I think that is a bigger risk for the economy. We get to, we put this in our outlook. We said elevated rates are a risk to the economy. We're hopeful about rate cuts, right? We said tariffs were a threat, and now that's manifested in, any number of ways. But elevated rates is still a threat. Like mortgage rates are close to 7%. The housing market's not going to function, right? Yep. Manufacturing's struggling still. So you don't have the cyclical economy firing on all cylinders.
Small business, once again, NFIB came out this morning, a little bit weaker. Yeah. I mean, so, there's some pros and some cons out there. But I will say this much. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. And then Facts versus Feelings versus VS. Facts versus Feelings at carsongroup.com is our email. Let us know how we're doing. And again, this was episode 135. Holy smokes. Are the lows in? We think the lows could be in. I will say this also about May. Somebody called it this, and I really liked it. It just feels like things are very busy with kids, end of year, just cramming stuff in. Someone called it May-cember. Because like December gets really busy, but May-cember really feels like that when you have kids. Are your kids busy? Like tonight, we have a chorus thing for my one son, Gus. We had chorus last week for Sebastian. By no means are they professional singers, but they both did chorus in school. It's just more stuff in the evenings during a busy time frame. Your kids super busy in May?
Yes, they have. My son's going into this Friday. He's got a blue belt karate test, something. Wow, I hope he passed. He had to be invited to do the test, so I assume they're going to pass him. Although pass him, so I'm hoping you don't invite him and then fail him or something. That would be pretty brutal. But hopefully they're good folks. And so he's doing that. My daughter does karate too, and so she's going to come in for the test, but she recently got her orange belt. So it's white, orange, and then blue. So they're slowly progressing. They started last year. So there's that. My daughter had a dance recital. I feel like we hit a cusp, like the top of the mountain. And then, dance classes are over for the summer. Okay. Right? We're slowly easing into summer mode. But May is very busy because suddenly tomorrow I have to go to school because there's something else going on for the kids. And that's in the evening. I'm like, I can't write my daily note at 5:00 in the evening. But which is fine. I'm happy.
I'll see you at midnight. You and I do a lot of work in the evening. We enjoy what we're doing. I was going to say something else. May. I don't know. I don't know what I was
like that. May-cember.
Yeah, May-cember.
A lot of graduations.
Now
a lot of graduations.
Oh yeah, my daughter is a junior in high school, so next year I'm just not even going to try to travel in May because I know it's going to be very busy senior year. So again, we have Skanda next week. We're recording with him on Friday. Will the black belt? Sorry, I'm giving him will the belt decision be made before or after that? Are we recording?
It'll be Friday evening. Yeah.
So we'll know more. But here's the cool thing: next week. What is today? Today's Tuesday. So like a week from right now, we will be in Omaha for the Carson Partner Summit. We invite all of our partners all around the country to come visit for 3 days. Just an incredible conference with a lot of talking, a lot of learning, a lot of laughing, a lot of fun. You and I will be on main stage with none other than Dan Ives. And hopefully. That will be, Dan said something about the only direct flights he needs to move. We can't move it. So I hope it's with Dan Ives. I'm putting it out in the universe now. Dan Ives is going to make it. If not, we'll just wing it. That's all right. But we're huge fans of Dan. He's awesome. Totally. So he's been on before. So that'll be in 2 weeks, the recording of our discussion with Dan Ives live from Partner Summit in Omaha. And if you want to go to Partner Summit, you have to join up with Carson. And you have to join up with Carson to do that. If you're an advisor, you're not happy where you are, check out carsongroup.com. Reach out to Sonu, reach out to I. We'd love to talk a little bit, reach out to Sonu myself, I should say. We'd love to talk a little bit more about the ways we can help you grow your business and have a little bit of fun and keep your clients happy. And that's what we're doing every single day. All right, Sonu, any words from you? And then I'll bring us home.
I'm happy April's over. Tariffs are over. Hopefully they don't come back. 90-day pause turns into maybe a 3-year pause. I don't know. I'm hopeful, but things are looking up.
No,
it's a good thing. And summer is coming.
Yeah, summer is, you can't stop it. Summer is on the way, which is good given the rough start to this year as we've had for investors. But hey, the lows of the year are likely in. There's going to be more volatility coming, but we're going to be doing this podcast every single week, Facts versus Feelings. We appreciate everyone. It's some really good downloads and listens, and the YouTube channel is doing really well as well. And thanks to Josh, our producer, who does a lot of work behind the scenes to make sure this gets out in a timely manner and as impactful as we possibly can make it. So with all of that, Next week we'll be with Skanda. We appreciate it. Enjoy the rest of May-cember, everybody, and we'll see you then. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.